Hi there. In this video, we'll start talking about a new part in the consolidation that might happen between the parent and the subsidiary company. And to give you a quick review on what we have discussed in the previous two chapters, that in chapter 2, we were talking about a parent company that purchased 100% of the subsidiary, but the investment and the book value of the subsidiary are equal. So we didn't have any problem about the acquisition, the recognition of the net income and the dividends. But in chapter 4, we talked about a partial ownership where the parent company purchased above 50%, but below 100%, anything between 51 and 99. And this one, we call it partially owned ownership. And here we start to see a new account called NCI, non-controlling interest. And we have to consider the non-controlling interest in the net income, in the dividends, and in the shareholders' equity. But now in chapter 4, we go back to the ownership for 100%, but the investment is different from the book value. Most of the time, the investment that we will see in the exercises is higher than the book value. So how can we recognize this investment and how can we amortize the difference among the years that was allocated? So with this in mind, let us go through the presentation quickly and take 4 examples that I have prepared. So in this chapter, we talk about wholly owned subsidiary. It means purchase of 100% of the subsidiary company. It means there is no NCI. And we paid more than the book value, so there is a difference here that will be amortized over the years. So in chapter 2, to give you a quick recap on the journal entries, because I'm going to use most of them in chapter 4. In chapter 2, we said whenever we buy a company, we might pay cash or bonds or preferred stock. What is the journal entry for payment in cash? We debit investment in subsidiary company and credit cash. But if we give bonds payable, we face an issue here. The fair value of the bonds payable might be higher than the par value or lower. If the bonds payable has a higher fair value than par value, then we create a new account called premium that will take the difference between the fair value and the par value. But if it's lower, we create another account, we call it discount. And no way we can have discount and premium in the same journal entry. It's either discount or premium. But I put them here so I can have the two situations in one journal entry that will help you to remember it when you come across some examples like this. But what will happen if we give common stock or preferred stock and we face the same issue as bonds? The fair value is higher than book value or lower. Here we debit investment and credit preferred stock. So we debit investment in subsidiary company, credit preferred stock. If the fair value of the stock is higher than the par value, we credit additional paid in capital. Otherwise, we debit additional paid in capital. And of course, if the fair value is equal to the par value, then there is no additional paid in capital. And we had this journal entry several times in chapter 2, and we will use the same journal entry now in chapter 4. So we make this journal either in cash or bonds or preferred stock in the acquisition date. But at the end of the first year, the subsidiary will continue operating and will make some income and some dividends. How can the parent company recognize the net income of the subsidiary or the net loss of the subsidiary or the dividends of the subsidiary? Remember, the parent company will take all the net income and all the losses and the dividends because the parent company owns 100% of the subsidiary. In case of net income, we debit investment and credit income from subsidiary company. But in case there is a loss, we reverse the income journal. So as you can see here, we debit investment, credit income. Here we debit income, credit investment. And we never call it unrealized gain or unrealized loss. We use unrealized gain and loss for the fair value method, but here we use equity method. And for the dividends, we debit cash, credit investment in subsidiary company. We make these journals every year to recognize the net income and the dividends of the subsidiary. And before we make the financial statements, we have to do consolidating entries. One for the shareholders' equity, where we close off the investment account, the common stock, and the retained earnings of the subsidiary. So we debit subsidiary common stock, debit retained earnings for the subsidiary, and credit investment. And by the way, you remember this journal from chapter 2, but we never put subsidiary at the beginning here. I put it just to explain that the common stock and the retained earnings are for the subsidiary, not the parent company. So in the consolidating entry, we debit common stock, debit retained earnings, but the amount should come from the subsidiary balance sheet. And we credit the investment. If the company, the subsidiary company, has depreciation during the year, we debit accumulated depreciation credit building and equipment. So all these journals, we made it several times in chapter 2. I'm going to use most of them in chapter 4, but I will add a few more accounts because of the difference between the fair value and the par value in chapter 4. So in chapter 4 here, we see it is wholly owned. So the parent will own 100%, but the investment is higher than the book value. And here we create a difference account that we have to amortize it over the years. So for the initial investment, we don't see any difference between the journal in chapter 2 and 4. We debit investment, credit cash or bonds or preferred, and I put all the situations in one journal because you already know the details from the previous slides. But for the net income, we debit investment, credit income. For the net loss, we reverse the account or the journal entry for the income. We debit income, credit investment, but now we see a new situation that we didn't have in chapter 2. We call it the amortization of the difference, because the investment amount by the parent is higher than the book value of the subsidiary. We take this difference and amortize it over a number of years that will be given to you in the exercise. So the same journal, we use it for recognizing the net loss. We use it also for the amortization of the difference. For the dividends, we use the same journal. We made it in chapter 2. And now we come to another issue. The consolidation of the shareholders' equity will be the same. We debit subsidiary common stock, retained earnings, and credit investment. But here we have a new journal entry that we didn't have in chapter 2, which is consolidating the differences together. We debit all the assets that will be mentioned in the exercise. So we debit inventory, building, goodwill, and we credit the investment. This journal entry, we didn't have it because in chapter 2, the investment was equal to the book value. So with this in mind, let us go to the 4 exercises that I prepared them here. And here is the first one. There is a company purchased 100% of a subsidiary for $280,000 cash. So if I don't mention anything, it means the amount is in cash. If it's bonds or preferred stock, it will be given to you. And on that date, the company had net assets of 205. So the parent paid 280. Meanwhile, the subsidiary book value 205. So how much is the difference between the two amounts? 75,000. Those 75, the excess, which is the 75,000, is attributable to depreciable assets with a remaining useful life of 5 years. This means we need to take the 75,000 divided by 5 years and then amortize. In the following years, so here we made the acquisition on January 1 of 2020, we come at the end of 2020, 21, and 22, and we see some income and dividends that have been made by the subsidiary that the parent company need to recognize. And here I put it on the Excel sheet, which you will find it on Brightspace, that here are the spaces for the 4 journals that we need to make in 2020, then another 3 for 21, then another 3 for 22. Honestly, I encourage you to put my video now on hold and take a minute, go to the Excel file and try to answer those journal entries, and then come back to see the answer for the exercise. So here is the answer for the first year, year 2020. We debit investment in the subsidiary by 280 credit cash. Then for the recognition of the net income, we debit investment credit income by the amount that was given in the table. Then for the dividends, we debit cash credit investment by the amount also mentioned on the table. But now, as you remember, I said we take 75 divided by 5 years, we get the amortization of the difference where we debit income, credit investment by 15,000. And this is the same journal we make it to recognize the net loss. What shall we do in the following year, in year 21? We will do almost the same journals here, except the investment. The investment, we make it only one time. So here there is no journal entry for the investment in the following year, but for the income and the dividends, we get the amounts from the table that was given in the Excel sheet, and we recognize the amortization as well. So we repeat the same journal we made it in year 2020. And the next year, 22, also there is no journal for the investment. For the income and the dividends, we get the amounts from the table, and then the amortization journal. So this is what we usually do if the investment amount is different from the book value. Now let us go to exercise 2 in the Excel sheet. And here we see the company didn't pay cash, but the company issued stock. How many shares? We can see them here. The company paid 51,000 shares, but the par value is $7 per share, and the fair market value $25. So how we get now the amounts? We multiply 51 times 7. I think we get 357,000, and then we multiply 51,000 shares times $25, we get 1,275,000. If we subtract it, we get 980. So the first amount goes to common stock. The second one go to additional paid in capital. And the third one will go to the investment account. And this what we should record in the first journal. But the book value of the company is 1,170,000. So we take the investment account 1,275,000, and we get the book value 1,170,000. And then we subtract them. We get 105. This is the difference. We divide it among 7 years. From where I get the 7 years, it's here. The useful life of 7 years. If we divide 105 by 7 years, we get 15,000. And this is what I'm going to do it here in the journal number D, where we amortize 15,000 every year. But there is another issue here. In the first year of 22, the subsidiary company made net income. In the following year of 23, the company made net loss. So here in B, I make recognition of net income, but here in the next one, 23, we make the recognition of the net loss. Again, I encourage you to take a minute, go to the Excel file and try to answer the journals, and then come back to my video to compare your answers. So here are the answers for year 22. We debit investment by the total amount, credit common stock by 357, additional paid in capital by 980. And then we make the recognition for the net income and the dividends. And then we amortize 15,000, and I showed you how to get this 15,000 earlier. In the next year, we don't do the journal for the investment, but here in the next year, we make loss. So we debit income, credit investment by the loss. The dividends will be the same, debit cash, credit investment, and the amortization will be the same as we did in the prior year. Now let us go to the third exercise that talks about another issue, where the company here made a payment of 66,000. So here we put 66,000. But the company, the subsidiary company, has retained earnings of 14,000 and common stock of 25,000. So the book value, here we have the investment account. And here we have the book value of the shareholders' equity. So the difference between them will be 27,000. This will be the difference. I need to amortize this difference over 8 years, as you can see in the exercise here. So if I divide 27 by 8 years, I get 3,375 that needs to be amortized. And the subsidiary company made income and dividends for the coming 3 years as for this thing. Now, again, we need to do the initial investment, the recognition of the net income, the dividends, and the amortization as we did in the prior 2 exercises. But the new idea in this exercise that once we finish the journal entries of the 3 years, we need to calculate the total balance of the investment account at the end of the 3rd year, which you see here in the next page of the Excel file. So let us make the journals, and then we'll try to calculate the balance of the investment account. Again, I encourage you to hold my video now, go to the Excel file, try to answer it, and then come back to continue check your answers. So here is the first year. We debit investment, credit cash. Then we recognize the income and the dividends from the table. But then we recognize the amortization of the difference here, 3,375 in year 1. In year 2, there is no investment account, but we make one journal for the income and one journal for the dividends, and the last one for the amortization. The same thing we do it in year 18, where we do one journal for the income, one journal for the dividends, and one for the amortization of the difference. Then we need to calculate the balance of the investment account. So as I mentioned earlier, we have made payment of 66,000. The shareholders' equity of the subsidiary retained earnings and common stock 39, so the difference 27. We amortize it by 8 years, so we get 375, and now we start calculating the balance. The initial payment of the investment, 66, plus the net income for the following 3 years, 72, that should be added to 66. And then subtract the dividends of the 3 years, and then subtract the amortization for the 3 years as well. So we multiply 300,375 by 3 years. And then we make the calculation here, we should get 102,875. And now let us come to the last exercise. And in this exercise here, we see that the company made a payment of $500,500, and this is in cash. However, the company had a balance here of the fair value of the assets. Here we have common stock 97 and the additional paid-in capital and the retained earnings, the three of them. We take the three of them, we add them together. So here we get 97,000 plus 22,000 plus 204,000. We get 323. And then we get the total value here, 500, and we subtract it to get the amortization and then divide it by the number of years, which is here 10 years. However, we have here inventory, which increased, and building, which decreased. So here, if I subtract the fair value minus book value, there is no difference in cash. There is no difference in accounts receivable, but there is a difference of inventory, and there is a difference here of the building and the equipment. And of course, we have the accumulated depreciation. So what I encourage you, again, take a minute to stop my video and think about the journal entries that you need to make here for only 1 year of 2019. And now let us take a look on the answer. So we debit investment credit cash by 500, and then the income and the dividends, we get it from the exercise. And then here we have the income from Salami, the amortization for 22,000. And for the income from the building and the equipment is here recognized. We take the fair value of the building and we take the net value of the book value of the building and equipment. So we subtract here, this is the cost of the building and equipment minus accumulated depreciation. The difference between them will be 113 divided by 10, we get 11,300, and this would be the amortization of the difference for the first year. I will go through the other exercises in the coming video. So I am working on more exercises to explain how to do the journal entries along with the consolidation of the financial statements, and I'll present them in the next video. So please remember, there is a big difference between a chapter 2 and a chapter 4. In a chapter 2, we see the book value and the investment of the subsidiary are the same, but in chapter 4, we see a difference and we have to amortize the difference among the years. I hope you find this short video is useful, and feel free to reach out if you have any question. Thank you. Bye-bye.